45 grand. That's the sticker price on the new car that you've been eyeing. That's the dream ride, right? But here's the thing, that's not the real price you're gonna pay, not even close. The real price is determined entirely by how you choose to fund the purchase. It's a decision that could leave you thousands of dollars ahead or thousands of dollars behind. So today we're gonna take a closer look at some common options. You can do a conventional bank loan, you can pay with straight cash, you can lease, or this is where it gets kind of interesting, you can strategically borrow from your own life insurance policy. Now, one of these options will allow you to get the keys of the car today and still get the financial win. So stick around because we're putting all the options head to head to see who comes out on top. Welcome back to the Banking Bros channel. I am Jonah and I am a certified numbers geek when it comes to cars. And I love finding better ways to make your money work for you.
And I'm Shawn, your resident slow it down so it sinks in guy. We might film from different studios, but we're on the exact same mission. Making money simple to understand, powerfully effective, and dare I say it, a little bit fun.
Today, we're talking about one of the most common and significant purchases a family makes, buying a car. The reason that it's common and significant is because the average American purchases 13 of these in their adult lifetime. But I don't actually just want to talk about the car itself. We're actually staging a kind of three-way showdown, if you will. We're talking conventional bank financing versus buying the car in cash versus tapping into a properly structured whole life policy. The strategy that sometimes you've heard on our channel, we call it the save and spend system, or a lot of people out there in the world are going to call it infinite banking. So let's set up our ground rules so everyone is on the same page. The car we're buying has a sticker price of $45,000. For our conventional loan example, we'll assume you'd normally take a 5-year bank loan and we're going to make up an interest rate at 7% because that's about where the average auto rates are hovering this summer. This is a very common scenario for millions of car buyers.
The second option is the one that many people feel is the most responsible, and that's paying cash. In this scenario, you hand over your $45,000 on day one and you walk away with the keys to your car. It feels great to be debt-free, but we're going to explore the hidden cost of that decision because you also lose whatever that money could have earned you if it kept working for you instead of cashing it out.
And the other option that we're going to contrast is the one that might be new to some of you, but you've already been building some strong financial foundations, hopefully, especially if you're watching our video. And if you've saved up $45,000 for this car in cash, you absolutely have built a strong financial foundation. But for this scenario, we're going to say you've got $45,000 in available cash value inside of this specifically designed policy. What you do is borrow against the cash value at, let's say, 5%. You let the original deposited dollars to get the policy started keep compounding at a completely separate rate, and we'll call that about 4%, and then you schedule payments just like a conventional car note. And we'll show you why this is a completely different game. All right, let's hit the math on our first contender, the conventional bank loan. You borrow $45,000 at 7% interest over a 5-year term, or 60 months. That comes out to a monthly payment of around $890. Over those next 60 months, you'll end up shelling out a total of $53,463. That means the bank gets $8,463 of interest because the car was $45,000 principal, right? They made $8,000 and change just for lending you money for 5 years.
And you're on their timeline, Jonah, not yours. That's the key difference. You're under a contractual obligation here. Miss a payment and you'll find that your credit score takes a serious hit. Miss a few more and guess what? You know they're coming for that car itself. The bank owns the title until you're done. This is the classic standard way of doing things. But as you can see, it's not just a car you're paying for. You're paying a significant premium for the privilege of borrowing from a third-party lender. It's effective, yes, but nothing about it is revolutionary or financially empowering.
Next up, we've got the second contender, a cash purchase. Now this feels responsible sometimes, right? I mean, there's a lot of people on the internet who will tell you to buy them in cash. So you walk into the dealership, you write your check for $45,000 and boom, debt-free. No monthly bill, no lender to answer to. But here's the part that most people miss. The part that a good financial coach will always point out, and that thing is called opportunity cost. That's the value of what you gave up by using that money for one purpose instead of another.
Exactly, Jonah. Let's do the math on that opportunity cost. What if you had invested that same $45,000 at a very reasonable and often conservative rate of 6%? 5 years later, that money would be worth just under $61,000.
Yeah, it's like you paid for your dream car, Shawn, and then without even knowing it, you also purchased a second used sedan that you never even got to drive, right? And you just left it in the parking lot. You bought it, but you don't get it. That's money isn't working for you. It's just gone. Now for the fun one, our third option, the policy loan from what we'd call our save and spend system. It's the same $45,000, but this time you borrow against the cash value you already have in the whole life insurance. Our assumption is that there's a 5% simple interest rate on the loan, and we're gonna mirror the bank loan payment, so $890 a month, because habits matter, and I wanna show you actually a direct comparison, right? Across the 5 years, you'll pay roughly $5,600 in loan interest, but here's the magic. During those same 5 years, the original $45,000 of deposited money, the money that's collateral for the loan, never left the policy. It keeps compounding at its own separate rate, so let's say call that 4%, like I mentioned earlier. That means it grew to about $54,900. That is an increase of $9,900.
So you paid $5,600 to access your own money, yet your policy earned almost 10 grand in the process. The net effect, a positive gain of around $4,300 over the 5 years, and you got to keep the car. Plus, you're in complete control. Skip a payment, there's no bank report to the credit bureaus. The loan balance just continues to accrue interest and reduces your eventual death benefit. This gives you unparalleled flexibility.
And that's not even the kicker. The interest you pay on the policy loan goes back into the insurance company's pool, which is the same pool that helps fuel your future bonus and dividend payouts for the entire company, including you, right? Your policy, you're a policyholder. So you're quite literally recycling dollars back into a system that you own and benefit from, instead of just donating them to the bank that you've got no stake in. So let's put this all on a scoreboard so you can imagine this 5-year cost recap. The bank loan, $8,400 gone forever to the lender, no residual benefit at all. The cash purchase, was it $15,700 in lost growth potential, right? Potential growth, opportunity cost, very real. It's invisible, but a very real cost. Policy loan, maybe $5,000 and change in interest out, but nearly $9,000 in compounding growth, a positive net return of $4,300. The numbers speak for themselves. It's not about which option is free. None of them are free. You've got to get a car, but it's about which option is financially responsible and most efficient.
And while different assumptions, interest rates, and policy designs will give you slightly different numbers, Jonah, the principle at the heart of this breakdown stands firm. When you finance through a financial system that you own and control, you get to keep more of the upside and you get to retain more of the control over your cash. It's a completely different and far more effective way of thinking about your money.
Now for the real world nuances. This isn't like a magical shortcut. There are a couple of crucial caveats that you need to understand. First, this strategy only works if you have a policy, and a policy that's been properly capitalized. You have to have the money in there. This isn't a day one magic trick, right? You'll have to have been intentionally building up cash value inside your policy, so that way you have enough to make the purchase. So that's why we call it the save and spend system, right? The saving is before the spending. You got to save first, right?
Second, while the major mutual insurance companies have paid dividends for over a century, dividends are not technically guaranteed. They're also not considered an investment return. However, you can feel confident knowing you're working with a company with an extensive track record of never missing a dividend payment. And third, a policy loan is still a policy loan. If you never repay the loan, the balance plus any interest will reduce your eventual death benefit. So you've got to treat it responsibly, just like you would any other financial obligation.
But here are the key differences compared to a bank loan. Every single dollar you repay to your policy loan doesn't go to a bank. It goes back to your own financial system. It replenishes your available cash value, and that's like putting gas in the car you own and get to keep forever, instead of putting gas in a rental that you got to give back in a week.
This is the most powerful visual in all of this, Jonah. Even while the car's value is sliding into a depreciating liability, your policy's cash value continues to climb uninterrupted. That is the essence of how you can turn what is typically a depreciating liability into a catalyst for an engine that keeps earning for you, all while you get to enjoy the car.
So what's your next step after watching this? If you're already a policyholder, already have an infinite banking policy, or maybe you're with us and you've got a save and spend system policy, log in, right? Check your cash values. Maybe call if you need help running an illustration with like a purchase in mind. So we can see how that looks for you in a specific situation. And if you're brand new to this concept, the first step is to learn how to get one of these policies so it's usable and it's accessible and you can have access to capital fast.
And before you ever hit the dealership, know your numbers. Don't go into it blind. Compare bank quotes, run the opportunity cost math on the cash purchase, and talk to a professional about getting a policy designed that fits your specific needs and goals. That's where the real power is, in planning and preparation.
So I don't know about you, but if you're ready to see how this system could fund your next car purchase, and it doesn't matter if it's a car, maybe it's a new house, maybe it's a boat, maybe it's a fence in the backyard or a business venture, here's what you should do. Click the link down in the description to schedule a free strategy call. We'll walk through your numbers one-on-one. We'll show you custom illustrations for your specific situation. This isn't just about a car, it's a financial mindset.
And if this breakdown opened your eyes to a different way of thinking about money, please hit that like button, subscribe to the channel for more powerful insights, and share it with a friend who's about to sign on that dotted line over at the bank. This is information that everyone needs to hear.
Cars lose value, but knowledge doesn't. Be the driver, not the passenger, in every single money decision that you make.